Okay, good afternoon, everyone, and welcome to Spring Estate Planning with KCoe Isom. My name is Claire Weinzerl, and I'm the Communications Manager at the Illinois Soybean Association. In today's webinar, KCoe Isom's Beth Swanson and John Dempster will discuss key terms and tools used by estate planning professionals, help us understand trustee responsibilities, and go over some potential legal changes. This webinar will include time at the end for you to ask any questions that you may have. So please feel free to type those questions into the Q&A function at the bottom of your Zoom window, and Beth and John will answer those following the presentation. Just one more note that today's webinar is being recorded in the event that you would like to rewatch it or share it with your network. So without further ado, I'd like to introduce today's speakers, Beth Swanson and John Dempster. Beth is a manager at KCoe Isom, spending her time with the National Tax Solutions and Next Gen teams. Beth helps businesses and families navigate tax legislation and find creative and effective ways to minimize tax burden. She works closely with families and businesses to plan for and attain long-term objectives, develop strategies to help family businesses plan for ownership transitions, and helps families navigate through the estate planning process. John is a manager at KCoe as well. He has specialized in trust, gift, and estate tax compliance for over 6 years. He has also helped farming families and other small business owners implement estate plans to meet their goals of tax mitigation, asset protection, and succession planning. Please join me in welcoming Beth and John.
Thank you, Claire. Appreciate the opportunity to speak here and appreciate all of you for joining us. When last KCoe met, we reviewed the current estate tax laws and possible changes to help determine your estate tax exposure. We also reviewed the other reasons for estate planning, including protecting assets from creditors and divorce. We hope our last meeting helped you gain an idea of what type of estate planning you may need and how urgent the planning is. I can assume that very few of you who attended our last presentation and who are here today have taken steps to implement an estate plan, even if you realize estate planning is an urgent matter for you. I don't say that because I think you're lazy. I know that's not true. The reality is you're all very busy, and there just isn't time to take out of your busy schedules to think about how you will operate. Your operation will continue after your passing, and when you have your hands full of chores that need done today. We also know how overwhelming the estate planning can be. Not only is thinking of your passing hard to do, there's also a lot of terms and tools that estate planners are using, and understanding your options is difficult. For this reason, I'd like to start off today with some discussion of key trust components to help you build a foundation of knowledge around trust so you don't feel so overwhelmed when it comes time to start your planning. Then I'll review the responsibilities of a trustee, because appointing a trustee can be one of the hardest choices when setting up your own trust. And many of you in this meeting may already be a trustee without much knowledge of what your duties are. After that, Beth is going to review some of the potential changes to estate tax laws, how likely the changes are, and how you should respond to them. Go to the next slide, Beth. So we're going to start off by looking at key trust components. A living trust, it's just like it sounds, it's created during your life. A testamentary trust is one that's created upon your passing, and the terms of the trust are listed within your will. A revocable trust is created and funded during your lifetime, and it is completely amendable, can be revoked during your lifetime. An irrevocable trust is created and funded during your lifetime, but it cannot be amended. The grantor or settler, those terms are interchangeable. This is the person who is creating the trust and transferring assets into the trust. The trustee is the person who is appointed to hold and manage the assets that are placed in the trust, and they will manage the assets on behalf of the beneficiaries. The An independent trustee is an objective decision maker for the trust. Can be a trusted friend or a bank, trust company, lawyer, accountant. The grantor will rely on the independent trustee to make decisions that best serve the interest of the trust rather than the beneficiaries. Commonly, this independent trustee will be in service when you also have other trustees that are beneficiaries. So they have some independence. And then the beneficiary is the person who is going to receive those assets or enjoy the beneficial use of those assets. There are two types of beneficiaries. One would be that current income beneficiary. They will be enjoying the beneficial interest of the assets that you put in there today. And then the remainder beneficiaries will enjoy will use the assets once that initial beneficiary has passed. Go to the next slide, Beth. So a revocable trust established during your lifetime, and like I said, it can be amended or terminated at any time during your lifetime. Assets placed in this type of trust are considered part of your taxable estate. So this trust will not help lower your estate tax liability. It does provide many non-tax benefits. One of the biggest benefits that you'll receive is allowing your estate to avoid probate on your passing. So probate is the legal process of proving a will and accepting it as a valid document, then distributing the assets per the will. In Illinois, probate is required if your assets exceed 100,000, if the deceased owned real estate, or if the family contests the will. If assets are required to go through probate before they are distributed to your heirs, they will receive those assets for at minimum they will not receive those assets for at minimum 6 months, and in most cases, much longer. There's also a cost associated with probate for legal fees. The cost of a simple estate in Illinois is on average $6,000. Probate is also a public filing, which means anyone could go into the courthouse and see a list of your assets after your passing. So funding a revocable trust will allow you to keep your information private, avoid the cost of probate, and allow your heirs to receive those assets more timely. Because with a revocable living trust in place, assets are distributed pursuant to the terms of the trust and without having to go through probate. Note that assets placed in a revocable trust are typically distributed to your heirs after your passing. So if you want to be able to watch your heirs enjoy the assets you will want to use a different estate planning tool. Also, as I stated, those assets are still part of your taxable estate, and as such, you will be taxed on the income that it generates, just like you were holding them individually in your name. Next. Yep. The most common structure with a testamentary trust or revocable trust is what we call an A-B structure. So this is where when the first spouse passes, the maximum amount that will be excluded under the current estate tax exemption will be left to Trust B. This is also commonly referred to as a bypass trust, the family trust. This trust is going to be irrevocable and will pass to the beneficiaries upon the surviving spouse's death. You will be able to set the terms of how Trust B operates, as well as how Trust A operates. Anything in excess of the estate tax exemption will go to Trust A. This trust will be for the benefit of the surviving spouse and will receive all the income, I should say, will commonly receive all of the income associated with the assets going into that trust. When the surviving spouse passes, that trust will also commonly go to your beneficiaries. Trust A will be in the surviving spouse's estate. So currently, each person has their own estate and gift tax exemption. That amount is for the year of 2022 is 12.06 million. There's an unlimited marital deduction. That is why this structure is common. It allows you to use up all of your estate exemption by funding Trust B, and then anything extra will go to your spouse in Trust A. And so on the first spouse's death, there will be no estate tax associated with it. And I should also note that this would be federal estate tax. So this trust remains beneficial with, sorry, I spun out a little bit. The benefit of this with Trust B is that all assets going into their values will be frozen. So they will be allowed to appreciate outside of the estate of the surviving spouse, while the surviving spouse is still able to enjoy some current income interest of it. The structure also provides flexibility because Trust A and Trust B can have different provisions and beneficiaries if you desire, instead of just having the one trust. Go ahead, Beth. An irrevocable living trust is established during your lifetime and cannot be amended or terminated. That makes setting up these trusts more detailed and overwhelming. But due to the trust's irrevocable status, assets placed in the trust will no longer be part of your taxable estate. Placing assets into an irrevocable trust is a great way to lower your taxable estate, your estate tax liability. And although you cannot amend the trust once it is set up, you can direct the terms of how beneficiaries get access to the trust as the trust is being drafted. For example, you can write your trust so that your children receive assets when they are 18, or maybe they can't access the assets until they are 35, or maybe only after they graduate college. So these terms are completely up to you. Along with deciding the timing of when beneficiaries can receive assets in the trust, you can also appoint any beneficiary that you want, and do not have to include anyone that you don't want as a beneficiary. You can state that the beneficiaries are all of your lineal descendants, which would prevent your kids' spouses or stepchildren from receiving benefit from the trust, if that is what you wish. Or if you want to include in-laws and stepchildren, then you can also add them. As I stated before, placing assets into an irrevocable trust essentially freezes the value of those assets at today's value, because all of the future appreciation of the assets in the trust would be excluded from your taxable estate. Illinois does have a rule against perpetuities for trusts created after January of 1998, which means that a trust created after such date can remain enact forever. This is how irrevocable trusts are able to create a legacy for multiple generations to benefit from outside the estate tax system. Assets placed inside the trust can pass by your children's respective estates and even skip to your grandchildren's estates and beyond if desired. Another powerful component of an irrevocable trust is that the assets in the trust are protected from creditors and divorce. So say you place ownership in your farming entity into a trust for the benefit of your daughter. As long as the trust has certain provisions, such as your daughter is not also the trustee of the trust, she can't make changes to the trust or distribute income to herself, then under Illinois law, the farm is considered property of the trust, not marital property. Therefore, it is not subject to equitable distribution between divorcing parties. Because the farm is considered property of the trust and not the individual, it is also safe from other creditors. Next slide, please, Beth. The main reason people are hesitant to proceed with the estate planning is due to the fact that irrevocable trusts cannot be amended and assets placed in the trust are outside of your taxable estate. And therefore, people have the perception that they will lose access to cash flow from these assets, lose control of operations, lose flexibility with their operations. So although the irrevocable trusts cannot be amended, they still offer a lot of flexibility. One provision that can be inserted into the trust is your ability to substitute assets. So this means that if you place $300,000 of land value of land into your trust and later you want that out of your irrevocable trust, you can't amend the trust, but you can substitute that land. You can substitute 300,000 of artwork, say, into the trust and take out the land. Distributions can be made to beneficiaries for health, education, maintenance, and support. And these categories cover a lot of the reasons for a distribution. However, a beneficiary may want to get a distribution of cash from the trust to go gamble in Vegas. That would not fall in line with those standards that you're setting for health, education, maintenance, and support. As stated before, an independent trustee is an objective decision maker and not someone who can benefit from the assets in the trust because they cannot receive any benefit. They don't have any beneficial interest in the assets of these trusts. They have more broad powers to distribute the assets to beneficiaries. An independent trustee would be able to distribute cash to a beneficiary who would like to spend the money on gambling. And that would be completely at the trustee's discretion. It is true that you will not be able to change some provisions of the trust after it is established, such as the terms of the trust or adding and removing beneficiaries other than charities. I can assure you that if you are using the right tools and structures, the cost experience can be significantly reduced or eliminated. Another reason people do not want to use irrevocable trusts is because there will be increased tax rates for assets in the trust and a perceived hindrance on business management. Trust income tax rates are similar to individuals, but they have a much more compressed tax brackets. Trust reach the highest tax rate, which is 37%, at $13,450 versus a couple married filing jointly, which is $647,850. However, you are able to complete tax planning with your trust and lower your tax liability. Trust income is taxed to the trust to the extent that income is retained inside of the trust and not distributed to the beneficiaries. So you can set the provisions of your trust to allow for distributions of income to your beneficiaries, which would allow that income to be taxed at their individual income tax rates instead of the trust brackets. irrevocable trust can also be set up as what are called grantor trusts, or intentionally defective irrevocable trusts. Within this trust setup, the assets are still outside of the grantor's taxable estate, but the grantor is responsible for paying the income tax on the assets inside of the trust. Essentially, this creates a what we call a tax burn, because you are using assets still in your taxable estate to pay the taxes on the assets already outside of your estate. Next slide, Beth. One of the hardest decisions, as I've mentioned, when creating a trust, is determining who the trustee will be. Whether you're needing to choose your own trustee or you're currently a trustee, these are important trustee duties to be aware of. So, carrying out the intent of the donor in accordance with the trust documents. So commonly you'll be asking a family friend, someone that you know well, to be a trustee, and that is likely how you are also a trustee. So one of the reasons there is you know the grantor well, and you're able to carry out their intent, their purpose for creating this trust. One of the main decisions that you may be asked to be a part of is knowing when to make distributions to the beneficiaries and when not to. You'll also be responsible for providing annual accountings to qualified beneficiaries, if that was one of the intents of the grantor. You'll be providing other notices, such as filing tax returns, like I said before, making distributions. You'll be responsible for paying bills. For many of these, it may be as simple as any tax preparation fees and investment fees for example, if brokerage, if you're have assets invested with a broker or other some asset management company. You'll also be responsible for the how the assets inside of the trust are invested and managed. For example, if land is placed into an asset and later sold, you would need to manage the cash related to that sale, whether that ends up being distributed to beneficiaries or if it will be continued to be invested and serve as income generation. Because the trust can be comprehensive and trustee duties can become very complicated and or time consuming, for those reasons, you may want to consider a corporate trustee instead of an individual trustee. In more cases, an individual trustee, such as a good friend or neighbor, will charge a low annual fee, possibly no fee at all, when the grantor is still living. A corporate trustee is going to charge you a percentage of the assets that are being managed. You may want an individual trustee when the grantor is still alive and a corporate trustee after the grantor passes, when there's more trust administration to be done each year. Keep in mind the capability of individuals you would like to appoint as your trustee, and the complexity of the trust when deciding if an individual is the appropriate choice over a corporate trustee. That is all I have, Beth. I'll turn it over to you.
Thanks, John. Good afternoon, everyone. So let's talk about the potential changes in the law and how this could affect some of the estate planning tools that John discussed that you have available to you. When we last spoke back in January, our predictions were to expect some significant and drastic changes to the estate tax system. So we expected that senators that supported wealth taxes, like Senator Warren and Senator Sanders, would attempt to gain some traction again, that we'd expect to see some proposals to increase estate tax rates and decrease the estate tax exemption, to eliminate the ability to use or reduce the effectiveness of grantor retained annuity trusts and other types of grantor trusts, to strengthen the generation skipping transfer tax, which assesses tax on gifts from an individual to a person that is more than one generation removed from them, to eliminate valuation discounts, which is something that was originally proposed in the 2021 version of the Build Back Better Act, as well as we expected to see some proposals removing the step up in basis of assets at death, or requiring the realization of capital gains at the time of gift or an individual's passing. So let's see how our predictions fared. President Biden released his Green Book, his list of budget proposals and suggested tax law changes in late March. Since the Build Back Better Act ended up on a bridge to nowhere, it's not surprising that a number of these proposals in this latest round look familiar. So these proposals would, among other things, reduce or eliminate some of the benefits of irrevocable grantor trusts that John just discussed a little bit earlier, and would make transfers to those types of trusts subject to capital gains taxes and includable in the grantor's estate, which is a key feature that John discussed of those irrevocable grantor trusts under current law. Additionally, in a critical shift, the proposal would require gift givers to pay capital gains taxes on the date that they give away property, would require decedents to pay capital gains taxes based on the fair market value of the property that they own on their date of death. This would effectively eliminate the longstanding principle of the step up in basis at an individual's death, which has been a key feature of federal estate and gift tax law for the last 100 years. Beneficiaries of an estate then would receive a basis in the inherited property of the asset's fair market value on the decedent's date of death, but that would come at the cost of capital gains taxes paid on the decedent's final income tax return. Finally, one other important point to call out that doesn't really directly affect estate planning, but would affect producers, especially in land-intensive activities, the ability to trade business real estate while deferring gain on that real estate is critical. And the administration has reintroduced its 2021 proposal to limit the amount of gain that can be deferred in a like-kind exchange to $500,000 per person per year, or $1 million per couple. So if you have land that has substantially appreciated and you want to trade that land, if you and your spouse have built-in gain on that property of more than $1 million, any amount of gain that you have in excess of that $1 million would be subject to capital gains taxes. So let's compare our predictions to the current reality. So we were right that the administration would continue to target grantor trusts, would look for ways to increase trusts that are subject to the generation skipping transfer tax, and would continue to attempt to eliminate the tax-free step-up in basis at death. Fortunately, there were areas where we were not correct, that we would see continued or increased proposals. So we were wrong that the wealth tax proposals would continue to surface. We haven't seen much activity on that front in the last few months. Additionally, as of today, there's no current proposal to decrease estate tax exemptions or increase tax rates. Finally, while it seems that the proposal to eliminate valuation discounts last year was popular with some congresspersons, there's no current proposal on the table that would eliminate valuation discounts on family businesses. So how much should we really worry about these proposals? Some of the factors that caused the Build Back Better Act to grind to a halt in 2021 are still present in 2022, meaning that it's possible that the president's Green Book for the fiscal year ending in 2023 may not go very far either, or at least won't go very far in its current form. Senators Sinema and Manchin are still hesitant to approve key pillars of the Biden agenda, including incentives for alternative fuels and increasing tax rates. But the latest proposal does have some changes based on feedback that was received from those senators last year that could pave the way for some more movement and compromise from both of those holdouts. So according to the administration's calculations, this proposed budget would reduce the federal deficit by $1 trillion over 10 years. And the proposals do significantly scale back both the climate change proposals, the alternative fuel incentives, and any plans that were included in that original slate of proposals to tax the very wealthy or to increase marginal tax rates. That said, what felt like Senator Manchin's biggest issue last year was the speed with which the congressional Democrats wanted to act. The latest news that we've seen is that Senate Democrats are targeting Memorial Day to introduce a new budget reconciliation bill. Last year, a handful of weeks before bill introduction was much too fast for Senator Manchin. So only time will tell if the fact that some of these proposals are old hat by now will mean that Senator Manchin feels less rushed. Overall, it seems that while the Biden administration has taken some of that criticism from the more moderate senators and made some changes to the proposals, there are a lot of key factors of the Biden agenda that remain unpopular with the two senators that are really going to be critical to the success of this budget. So I would say there's not too big of a reason to be concerned about all of these proposals that I've just discussed over the coming months. But as we see in a few weeks what actually gets introduced to Congress, I think then would be an appropriate time to start really getting concerned about, if any of these proposals that could more directly impact you remain in effect. So let's talk about responding to changes. Really, not much has been enacted recently, thanks to congressional deadlock. So the only things that have really changed are the annual IRS inflation adjustments, which are adopted every year by the service just in a notice. So they're not something that Congress has to act on. So as John had discussed earlier, the 2022 estate and gift tax exemption is just over $12 million per person. That's an increase of about $360,000 from 2021. And the 2022 per recipient gift tax exclusion is $16,000, which is an increase of $1,000 from the $15,000 that we had for about 3 or 4 years prior to this year. The beneficial provisions that will expire soon. So even in the absence of congressional action on the Biden agenda, there are pieces of federal estate and gift tax law and other tax law that are beneficial to producers that will expire if no one takes any action. So first is the doubled estate and gift tax exemption. So the Tax Cuts and Jobs Act took the federal estate and gift tax exemption from $5 million per person adjusted for inflation and doubled it to $10 million per person adjusted for inflation, which gets us to that $12.06 million number that we've been discussing. Without any action, that doubled estate and gift tax exemption will sunset at the end of 2025. So in 2026, if Congress doesn't do anything, the estate tax exemption will be cut in half to $5 million per person adjusted for inflation in 2026. For context, that means if it were cut in half this year, the estate tax exemption would be about $6 million per person. And something else to note is that after the end of this year, 100% bonus depreciation, so your ability to take a full depreciation deduction for the cost of new equipment that you purchase in a year begins phasing down. So in 2023, bonus depreciation would be 80% of the cost of your new equipment, new or used equipment. And after 2026, bonus depreciation would not be available. This one, we typically don't worry about too much because it seems that Congress always comes together to act to ensure that bonus depreciation survives in some way. But as we saw in 2017, there were some additional complications that arose because of how late Congress acted in the year to allow for 100% bonus depreciation as a result of the Tax Cuts and Jobs Act. Some other things to keep in mind that John had mentioned earlier, there are some Illinois-specific concerns. So Illinois is one of 12 states that impose a state-of-state tax, and the threshold for taxability is $4 million. So even if you don't have a taxable estate at the federal level, you may have to pay Illinois estate taxes. That tax is assessed only on your Illinois assets. So if you have assets in other states, that would not be subject to the Illinois estate tax. There are graduated tax rates, and the top tax rate currently is 16% for estates in Illinois that are worth more than about $10 million. There's a very complex calculation, but there is a calculator that's available on the Illinois Attorney General website. Also, there's an additional 5% tax on all of the existing tax rates that have been proposed. So we'll watch that pretty closely to see if the state assembly is able to actually enact that change. Additionally, something good to note is that the amount of Illinois estate tax that you pay does reduce. It's a deduction against your federal taxable estate. So if you're in a situation where you have an estate that is taxable both for federal purposes and for state purposes, whatever Illinois estate tax you pay is going to reduce the federal taxable estates. You'll get a deduction there. So what should be done now? We really recommend for people to take 4 key actions, especially in the face of uncertainty. So first, take the time to plan, review your assets and your existing estate planning documents if you have any. Determine your priorities in your estate and with your beneficiaries, your children and grandchildren. Consider who you want to run your business. If that is your children or your grandchildren, or maybe it's somebody outside of the family. You definitely want to know going into any planning discussion, sort of what the ideal end situation is going to be. Next, we recommend that you engage, either meet with your financial and legal advisors if you have them, or interview a group of financial and legal advisors to determine who's going to be the best fit for you, and discuss what you'd like to do next. Those individuals will have some ideas about how to create plans and documents that follow those wishes through to make sure that your wishes are clear and that future generations respect sort of that plan that you've got put together for your assets after you pass. Next, communicate. So start ongoing conversations, not just with your advisors, but also with your family. I know that this is a really uncomfortable and awkward conversation, but we've found that the more that folks are communicating, both with their advisors and with their families, the more clear everybody is on what intentions are and what really needs to be done. And finally, act. This doesn't have to be taking all of these steps this week or even this month, but it is important to begin the process now. The fast developing events that we saw in 2021 before the bill stalled out showed us that while bills can stall at any minute, deadlock can be broken at the drop of a hat as well. So the sooner that you begin to put pieces of your plan together, the more protected you'll be from any potential estate and tax law changes. So our intent today, of course, is to inform you about current and proposed estate tax laws and some key estate planning terms, but definitely wanted to leave with just a couple of bullet points about how KCoe can help. If you are looking for a financial and estate planning advisor, we regularly help producers and facilitate interviews to help you understand goals and wishes, review current estate planning and business documents, assess your current and future estate tax exposure, design plans to help you accomplish your long-term wishes, and conduct meetings both with you and your family if desired to review recommended options, answer questions, and outline how these plans can all get implemented. So a number of ways that KCoe can help if you are looking for a financial advisor to help you through this process. So with that, I will turn it back over to Claire and we can talk through any questions that anybody has.
All right, thank you for that presentation, John and Beth. We're now going to begin taking questions from the audience. So if you have a question, please go ahead and type it into the Q&A function at the bottom of your screen. It doesn't look like we have any right now, but we'll give it a minute for some to roll in. While we wait, do either of you have some final thoughts to share, maybe helpful bits of advice?
I think our best advice is usually to begin that planning process and those discussions as soon as you can. It is difficult, and as John had mentioned, we know that everybody is busy, but it's always worth the time to begin those conversations, even if you don't maybe get too far before you've got everything planted.
Yeah, I agree. The estate tax issues aside, you never know how long you actually have. So again, it's just starting at least to have conversations now is always better than trying to wait. So we always think we have more time than we end up having.
All right, well, we don't have any questions, but again, just a reminder that this webinar has been recorded. If you'd like to go back to ISA's YouTube channel and rewatch that, or share the link with your network. Thank you both, Beth and John, for your presentation today. And thank you all for attending. We hope you have a great rest of your day.
Thank you, everyone.
Thank you.